Good morning, everybody. Welcome to the Flow Show. Another bank to come. BOE after the Fed last night. Oh, I don't know what it is. I'm feeling all flustered this morning. I feel like I'm in a rush for everything. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. It's only February. Relax. You shouldn't be in a rush yet. No, not time yet to buy the Christmas presents. But I did wake up this morning thinking we were Friday, and I was relatively happy until I saw we're only Thursday. Okay,
yeah, that's
I
a
desperately need 4-day weekends.
Yeah, I should make them legal. But then we'd moan that that's not long enough for the weekend. Anyway, we're never happy, us traders, are we? Never happy unless we're making some money. Right, lots to get through this morning, so I'll try and grind through all the stuff pretty quickly. In China, Finance Ministry official says they will implement structural tax cuts in 2024 to support the tech, innovation and manufacturing sector. So more measures coming in China to help things along. President Xi says they will increase the resilience level of industrial and supply chains. They will also accelerate China's green transformation. More unions talking in Japan. The Kaidaman head Takura believes wage talks have started with a positive tone, but we need to see if wage momentum spreads to smaller companies. And one of the large Japanese unions, the UA Zenzen, they're a big services industry union with just under 2 million members. They say their group is seeking at least a 6% pay rise, but their chief, Matsura, believes 4% wage hikes are not enough. So they'll fight for 6%, but says there are hurdles for smaller sized firms to hit those levels. So we're looking at some lofty numbers there. 4 to 6%, I think, is probably the playground or the ball ground that we're looking at there. Anything below 4% will be seen as negative, likely for the BOJ. 4 to 6% is bang on the money. Above 6% would be a huge bonus for those guys. PM Kishida says he's not planning any tax hikes to pay for the Quake reconstruction. He also says that deflation may reoccur if pay doesn't keep up with prices. So he's still keeping the pressure on from that side. Over to the Riksbank, they've left policy unchanged at 4%, as widely expected, but they say the rate can be cut sooner than was indicated in November, and that a cut in the first half of this year cannot be ruled out. They're going to increase the sales of nominal government bonds, and they say conditions are right for low and stable inflation. Kay, anything from the Riksbank worth noting extra?
Yeah. Okay. It's a dovish report, but I'm not sure. I think usually we hear from one of them, whether it's over the day or the next day. And I'm a bit worried that well, worried is not the right word. I don't have a position in the stock. It can go wherever it wants, but I'm kind of thinking that they still had that program where they were hedging their reserves, right? Not intervening, only hedging. And I haven't seen anything about that in the statement, unless I missed it. That's keeping probably the market a bit on its toes, but yeah, it's in the letter at least a pretty dovish report, right? And Stocky has lost about 0.5% after it came out, and yeah, I still think if you look at divergences across economies, I say I'm not saying that Swedish krona should fall out of bed again, but for as long as economies are not going to start to really turn up, and especially Europe as well, because Europe is obviously the biggest trading partner of Sweden. Sweden will benefit from a European from Europe standing up, on the economic front. For as long as that's not the case, I'm going to, in mind at least, remain relatively, how shall I say, relatively defensive on Swedish krona.
Yeah, thanks, mate. I suppose NOK/SEK is the one to keep an eye on for the policy divergence between them and the Norges. There's a few of those popping up now at the moment. Aussie Kiwi being one as well, with the RBA inflation coming down and Kiwi inflation being a bit more sticky, and the central bank maybe turn a bit more hawkish. So, as we've been saying all through the last few years, the crosses are important, particularly when you want to play these sort of divergence trades, because they can be a bit cleaner and a bit easier to trade, clearer to trade than trading everything against the dollar and the Fed. So important to note about the crosses. Right, moving on. Excuse me. Eurozone inflation came out this morning. We've had a load of PMIs, but I'm not going to go through all the PMIs. You've all got calendars yourselves, and there's a ton of it. But Eurozone inflation was a big watch this morning. It came in lower than expected. Headline expected down at 2.7, came in at 2.8. Same for the core, came in 3.3 instead of 3.2. So it is dropping over last month, but not as much as expected. So still remains sticky, and that pushes out those expectations for early cuts further. ECB's De Guindos says he doesn't see a risk of the ECB cutting rates too late. Eurozone growth could be weaker this year than the ECB predicted, and economic prospects have worsened since December. That's a bit of a counter to what Lagarde said, where she noted a pickup in things like the PMIs point to tentative signs of an improvement. De Guindos taking a more bearish stance there. It says inflation will be slightly lower than the ECB predicted. ECB's Lane says ECB needs more confidence that inflation is headed to 2%. That was yesterday, so he must have copied, or Powell must have copied that line. Inflation is a smaller problem, but still a problem. ECB Centeno, the biggest dove over there, says if inflation continues on the same trajectory in the coming months, it is expected that the ECB's next decision will be to cut rates. Thanks for that, Sherlock. ECB's Herodotou says expects rates to start to decline in 2024, but must be on a data-based approach. Coming back to some of the data from yesterday, jobs data, ADP data came in on the soft side, 107k versus 145k expected. A little bit softer, still a positive number, still above 100,000, so no real problems there. One other number that Powell noted was the employment cost benefits number, which came out yesterday, the Q4 data. This is one of the numbers they're looking at in terms of, wage price spirals and things like that, and also, actual input costs. And it came in slightly softer than expected. Cost index 0.9% versus 1% expected. Employment benefits also dipping back too. So these numbers moving in the right way for the Fed. Canada GDP wasn't much of a muchness, a little bit better than expected. Then we've got the flash number, so they have a little guess at what the December number will be. They expect that at 0.3%. Again, another economy, 0. This, 0. That. Year on year came in at 1.1%, slightly higher than the 1% expected. Right, let's get into it. Mr. Fed, Mr. Powell, left rates unchanged. Altogether, the statement was fairly bullish. There were some language takeouts there and some additions there. The main lines being that they don't see cuts coming until they are more confident about inflation nearing 2%. As I say, pretty much word for word what Lane said. They said the risks to the goals are moving into a better place, and the Fed will still consider any adjustments to interest rates. They removed reference to the potential additional policy firmings. They took that out, which is an unhawkish move there. And they also took out, and this is funny, considering yesterday we had some headlines about one of the regional banks, the New York Community Bancorp. They cut their dividends and the market got a little bit panicky about regional banks in the US. Well, then in the Fed statement, they removed the line that said that the US banking system is sound and resilient. Maybe that was a forewarning there, or after the event anyway. They also took out the reference to tighter financial and credit conditions having a downward effect on employment activity and inflation. Now, that was quite an important takeout once you hear what Powell said in a moment. They also said that the vote was, or it showed in the statement, the vote was unanimous. And that's something I pointed out on Face yesterday, that maybe we start to get the dissenters creeping in, the doves creeping into voting against keeping policy unchanged, i.e. they want cuts. That's something a bit like the BOE voting system, but not a standout. And something we need to monitor going forward, because that will indicate when all these unanimous members start turning. Anyway, the statement went on to say that economic activity has been expanding at a solid pace. That was a change because the prior line said that activity had slowed from its strong pace. So again, a bit of a bullish twist there, that it's not slowing, it's been expanding. The risks to achieving employment and inflation goals are moving into better balance, but they're prepared to adjust if that risk to goals emerge. They say jobs gains moderated since early 2023, but remains strong. On QT, they said they will continue the same pace of reducing Treasury and MBS holdings. And in fact, QT wasn't even a real subject for discussion, in that they're going to continue as is. Right, over to Powell. So we had that bullish sounding statement, and then some of his comments, it's difficult. The market took it as it went the other way, and he was dovish and whatever, up to a certain point. Really, in my opinion, he was just stating out their stance that if the data continues, rates are going to come down. That's what they wanted from the get-go. And they're on the right path to do so. But anyway, he said, our restrictive stance is putting downward pressure on economic activity and inflation. Now, that was one of the dovish comments, or dovish-ish comments, after that removal of the reference to tighter financial conditions, putting the downward pressure on economic activity and inflation. Him saying that his restrictive stance, or their restrictive stance, is now the only thing that is creating that pressure, rather than the market adding to that. So that, you know, that gives them a reason to say at the moment it's our fault, so rates are that high. That gives them an indication to take rates down. Then said, if the economy evolves as expected, we will dial back the policy rate this year. The economic outlook, though, is uncertain, and they are prepared to maintain current policy rate for longer if needed. So there's the give with one hand on the hawkish side, take with one hand on the dovish side, playing that middle of the road as is often done. Says we don't think we necessarily need to see weaker growth for inflation to come down. Again, a little bit of a line there that they don't need to see economic weakness for inflation to come down, nor do they need to see it to start cutting. We don't look at stronger growth as a problem. Again, that line there about insinuating that they don't need to see growth coming down before they start cutting. Remember, they want to get rates to a neutral level, so they can do that even while the economy is growing. Almost everyone on the committee believes it will be appropriate to reduce rates. We are trying to identify a place we are confident on inflation to begin the process of dialing back from restrictive levels. We are not looking for a slide in employment, but would cut rates if we saw a weakening. Is that maybe a little nod to tomorrow's numbers? Are we going to start getting some weaker numbers? They said they're more concerned that inflation will stabilise at an elevated level. And then these are a couple of interesting comments. The first one, we are not looking for inflation to tap 2% once. we are looking for it to settle out at 2%. So that means inflation, it could drop down to 2%. That doesn't automatically mean a cut will come. It means that they need to see it staying at 2%. Good luck with that. I've never seen a central bank yet manage to keep inflation pegged to a particular level. It's either going to be below or it's going to stay above. But I doubt it's going to sit at 2% for any length of time, maybe more than a month or two at most. Then came the kicker, with the market getting a little bit bearish on the buck. He came out and said, based on the meeting today, I don't think it likely we will have a rate cut in March. So he put a big chokehold on all the March expectations pretty much. That's what caused the big rally in the dollar and the jump in yields. We were doing that, and then he came out with that comment, and we did that all the way through into 147.5 pretty much. So March rate cut expectations took a bashing. They're still running, I think, about 20-25% at the moment, but everyone's now kicking everything into May. That's when interest rate futures is pricing, so they all washed out of March and ran into May. Goldies moved their brilliant forecast from March to May. They're changing their mind like the weather as well. Shows you again how much bank forecasts are worth. So we're playing the same old game. Market's still expecting around 140 pips of cuts. The calendar is shortening for them to fit that all in. The market's still going for early cuts rather than summer cuts. So there's still a bit of disparity going on there, divergence there, which if we get to the May meeting and they don't cut again and don't indicate any form of cutting until the summer, then we're going to have all this repricing going on again. So that's that. Markets have moved this morning as they want to do. Has anything really changed? No. The Fed's on its path. The language is still soft landing. They've got the conditions for soft landing and bringing rates down. The Fed are winning the battle at the moment, and the market is continuing to have to adjust to the Fed's theme rather than its own theme. Okay, your thoughts, mate?
Yeah. So first of all, I'm going to stop calling those meetings dovish or hawkish. Okay.
Hey, at last.
Either it's going to be strong or weak. All right. So what I said yesterday, I made the mistake to continue. Well, I mean, like everybody does, to talk about dovish and hawkish. It's wrong. It's all wrong. It's strong or weak. And the statement was strong. And the first part of the press conference was weaker, and then he came back and he kicked it everything back to the other side. So the getting March out of the way, and but also one of the risks was that him talking about QT and that reverse repo. And he brushed that under the carpet as well, and that's what I was saying ahead of the meeting on my preview in our rooms as well. I said if he brushes QT and RRP under the carpet, which he did, he sent us to March to discuss about both of those things. That gives another month. When is it? 20th of March. That gives us another month and a half, roughly, to ponder on everything else. Of course, he said about the RRP that it shouldn't fall to zero. Yeah, okay, we know that, and we know it's coming down, but he wasn't sounding too alarmed about it either. But it's especially the pushback against March, which sent the dollar the other way, because he was looking a little bit like wanting to water down the statement, and he gave us some sort of that surprise in December as well, right? Besides walking, and he was jumping yesterday, he was continuously jumping to one and the other side of the line as well. But he was a bit less strong or less hawkish than the statement would give us to understand, right? But I think, yeah, I do agree. They're on their course. it's really, I mean, what have we been saying for months on ends now? They are at peak. They will start to cut. The question is when, and the answer to that is data dependent, and it's really data dependent. We will have to see the how the data evolve, and we will already have a very good idea. ISM today, I'm not so sure, but the market is really good unless that employment indicator is going to show us something really strong. But I think now it's over to the labor reports, right? Well, at least the NFP tomorrow, and then we will see about inflation and stuff later. But it is clear inflation is on the way to levels. The the tapping, no, it can't only tap, but it has to stick at 2% inflation. I think that was a different way. And the market, I'm not sure if the markets understood that correctly, to be honest, because some people bought a few dollars on the back of it. It's not that they are going to wait for 2% to start to cut interest rates. I think he is already in his mind saying, like, where is my final rate? But to get to my final rate, it needs to stick at 2%. And then I will get to neutral. And I think he was already front running way beyond when possible rate cuts can come, because in December he was pretty clear in saying that we do not have to tap the 2% before cutting rates, because that would really be probably too long, right?
Yeah.
But it's really the QT, RRP, and the combination of, especially, of course, the pushing back against March. So basically, that's ECB. ECB and the Fed aligned again for now, right? They both pushed pushing back, and that's it. And then pricing, repricing, it's all part of the game. I don't like to use the word that they are pricing in 25% of a rate cut. No, I think yields are where they are because economic outlook and people trying to figure out where the economic outlook will be are where they are. Whether they'll be at where the rates should be when March comes, that's a different question. I really think it's a factor of data, expectations. Yesterday, the yields got a bit of a hit on that regional bank. The day before, or 2 days before, a bit of a hit on the U.S. Treasury announcement. That's all part and parcel of how a bond market covers itself. I think the real question now is, are they going to cut? Are they going to cut the 1st of May? And that one, honestly, we can't rule it out right now because we don't have the data in front of us, right? If tomorrow you get a weaker report, that May is going to probably come in as people expecting a done deal in May, right?
Yeah.
So that is where we are now. We are extremely data dependent, even more data dependent, and that's it. And for the time being, if you look at the differentials, because I like to look at all those differentials, it's still one big trade. Are they fighting against expectations? Yes, they are. Is the market pricing in risk? Yes, it is, because the whole yield sphere came down a bit. Do you read that the dollar is going to take a direction on the back of Powell yesterday? I would say as such, no, but then you bring it back to growth, and then as we have been banging on about, the US is growing at a much faster pace than the EU. Now, the only thing we need to keep in mind is that the US is usually a more dynamic economy than the European, than the old continent, as we call it. So the changes could be more rapid in the US as well. So that is something that we will have to monitor. It's not, well, that is going to be the result of it, the diversion in yields, but it's a diversion in growth is still going to me. To me, that's still going to be the thing, and I put labor market in the same basket,
Yeah, as is inflation as well. So yeah, moving forward, you've only got two things to think about. What the Fed are telling us, and their message hasn't changed. It has not changed. Yes, language around it changes, interpretation of it changes in the market's eyes, but what the Fed are doing is moving along their path, soft landing, getting rates down when they need it. And Powell said it perfectly. He said what they're doing is risk management, basically the same as what we do. They've got an aim, and now they've just got to manage the risk in getting to that aim. That's not going too fast on cuts. That's not waiting for inflation to be at 2% before cutting, but it's also managing that cutting as well. As inflation comes down, they can start to cut before it gets to 2%, as they've told us. But they don't want to go too hard, too fast, and risk undoing all the work. So, yeah, they're in risk management game as well, as much as we are. It's not a foregone conclusion that they cut every meeting when they start cutting. They might cut once, pause and have a look, see what it does, and then decide to go again. So I still think the market is way out its pram with 140 pips of cuts, when the Fed themselves telling us they're only doing 3 at a median. So that's all you've got to focus on when you're looking at price action, what the market is doing versus what the Fed is telling us they're doing. And that's where you get your trades from, hopefully, anyway. Right, the next lot, Bank of England coming up in just over an hour. No expectations for any policy change from those guys. As always, what you need to watch is the votes. Last month we had a 6-3 vote. 6-3 vote. 3 members still voting for hikes. That's expected to go 7-2. I think there's probably a risk that it might be a bit more than on the unchanged side. It might be an 8-1. That's probably 7-2 is probably fair. The Hawks will want to stay on their side, so I reckon that's about fair. The only other risk is that Dingro's, one of the big doves, moves to a cut phase. I don't think she's justified in doing so just yet. But again, just like the Fed dissenters, be prepared that it's not just 2 votes we're looking at now. We may get sort of 3 votes, unchanged, hike and cuts. So if you get a surprise like that, it might catch the market on the hop. But yeah, I think probably 7-2 may be about right. I wouldn't be surprised if a couple of these hawks moved over to the unchanged line as well. So that's what I'm looking for today. Not that I'll be here, I'll be heading towards a train as I'm off up to town. So no policy change. It is a monetary policy report meeting, so we get updated forecasts and a press conference. So you'll have the pleasure of listening to Bailey for 45 minutes or so. I know Kay's going to love that. But yeah, it's all going to be, again, like all these central banks, about the language. March cuts, early cuts, well off the table as far as I'm concerned. The BOE data is much stronger than anyone else's in terms of being able to cut in March or early at all. Most of the market is looking the latter part of the year anyway, so there's not too many early cut expectations for there. Wide market looking at around 4 cuts this year, which might be a little optimistic unless the data really starts coming down in terms of economy and inflation. Still got sticky wages up in the 6%. That's going to be a feature, I think, for Bailey maintaining the higher for longer stance. But he is adamant that inflation is coming down and will come down to target fairly quickly. So let's see if that has changed in their forecasts. Price moves, I think, may be a similar setup to what we saw from the Fed. Look for any bullish, hawkish sounding noises, higher for longer type stuff to keep the quid supported. Anything that sounds dovish from him, and he has a history of doing that, and the pound might be in trouble. So watch your ranges. We're still in this 126, 128 range. Don't trust the levels too much right into the BOE because obviously the headline there the algo's jumping all over it. It can blow through the levels. It doesn't give a monkeys about coloured lines on your charts. If the market's going to move, it's going to move. Again, look at where we finish with prices after the BOE. That will be important. We can go all the way from 126, so that's getting cable anyway. We can go all the way through 126 down to 125 on a headline from the BOE. But after the BOE, we might be well back above 126 again. So, don't trust your coloured lines when you're going over the meeting. See where we are after, unless there's something you really want to trade. If you've got a level you've been waiting for, it's a bit of a stretch point from where we are now. You want to have a go, fine. Manage your risk against it. Know the conditions you're trading in. Kate, your expectations for Bailey?
Yeah, that's I think steering the course for now is the base case, right? And so the risk trade here, I'd say, is him not pivoting, but saying that yeah, we have seen that the economy is barely holding above the zero line, so there's risk to the downside, yada yada. I guess the risk is for a little bit more dovish than the base case. But then that's just a small risk. Yeah, I think we've seen those ranges that we're trading in, just to name the two, cable and euro sterling, 126, 127 and a half, and 84, 90 figure 80, 85, 60, 70 on the euro sterling. If you're outside that, once they're done, then you're probably going to create a move. If you're still inside, I guess we can just call it a day and wait for tomorrow US NFPs, right?
Yeah, very much so. Very much so. I think, that as much as the economy's had a bit of a bounce. We saw that in the services PMIs going nice and positive. Even a bit of an improvement in manufacturing, though that's the smaller sector. We've had this UK exceptionalism, tepid as it may be, for the last few months. So he's probably going to touch on that, but he'll probably lay that up with some. There's still very high risks around the economy and whatnot. So whatever side the economy is leaning, he's going to take the other side in terms of where the risks lie. So yeah, we may be doing better than everywhere else, but there's still risks to all that. So yeah, if you had to pick it, he's probably going to be not as bullish as Powell was, or not as bullish as the Powell statement was on the economy. But we shall see. I'm not going to touch this down here. Euro sterling. Yeah, go on, mate.
If I can just add, because Dingra is probably even worse than Centennial at the ECB, right? A worse dove, yeah. a bigger dove. I'd say if Dingra is the only one creating that disparity in the vote, I, as a trader, am probably going to discard that and look through it, because she is an uber dove, right? Yeah. If you would listen to her, even with 25% inflation, she would still keep the rates at zero. But it's the way that everything has been will be brought over, which is really going to matter to me. That unless the vote is starting to, and she is not the one taking the votes to one or the other side, then the votes are going to matter. But if she's the only one really dissenting with the rest, I'm going to happily look through that.
Yeah, I think if you're looking at those numbers, if it's 6.3 again, that would look more hawkish. If it's 7.2, that's pretty much on the money. If it's 9.0 for unchanged, that's going to be, as I say, that's the hawks moving over to neutral. That may be seen by the market as a little bit more dovish. The uber dovish outcome would be the hawks moving from hikes to unchanged, and that Dingra vote going in to a cut. So it would be an 8-1 for unchanged versus a cut. That would probably be the most dovish outcome we might get. Obviously, anything more than 1 in the vote cut, and that would be really dovish looking. So that's your ballpark. Yeah.
Yeah, then it's, yeah, I agree. If it goes more than 1 on the cuts and it's not Dingra, then it's probably that's going to end up weighing very heavily on the sterling, I reckon, at least for the day.
Exactly. And at the moment, for cable, that's a path of least resistance, although it is holding up slightly better than the euro at the moment. Right, let's get stuck into some of the other prices. Kay, it seems like the yen is doing a lot of the shifting because yields are pretty stable at the moment. You know, obviously 10-year US moved around over Fed and Powell and whatnot, but they're pretty stable this morning. So it's not really, we're not seeing dollar strength that's wide dollar strength because dollar yen is, again, just waffling around in a tight range. But the crosses are all going. The crosses have all gone this morning, although they bounce back a little bit now. What's going on, mate?
Yeah, I think this thing about the unions and seemingly governments looking a little positive and hopeful on that they will reach it. But of course, Kishida is a bit at risk with his party members flying out of the window one after the other on scandals, money scandals, getting money, using it for the LDP and stuff. But so he needs to use any good news. No tax hikes is probably read as that's more money or less money out of the consumers' pockets. Yeah,
and more they'll have to borrow.
Sorry?
And more that they'll have to borrow to pay for any.
Yeah, that is one thing as well. Although because the rest of the yields have come off, but the Japanese JGB yields are relatively stable. Yeah, the yen crosses have reacted to all of that.
Maybe also that some of the market now, the Fed's sort of all but written off hikes. You know, the BOJ might be the only hiker in town.
Yeah, well, definitely that's always going to be the case here. But then it's the thing, it's the revenge of the low yielders, and you find even though dollar Swiss is higher, but you also find it back in stuff like Euro Swiss, for instance, which is not really bouncing much. And other currencies versus Swiss franc who are relatively on the weak side. It's like the revenge of the low yielders, right? In those cases, that's part and parcel of how you trade yield differentials. Is it all sustainable? That's again my question on the on the yen. Imagine that you have a half decent labor report tomorrow, and the market says, okay, like the big jobs market domino in US is still standing. We can't trade that to expect the Fed to lower interest rates, and you trade the 10s back above 4%. Your dollar yen is probably back at a closer to 148. But yes, in all terms, it does. It is part of the early 2024 trade. Is the yen crosses are starting to find tops and coming down. My question is always, is it going to be sustainable?
Yeah.
It looks like to be at least a couple of days at least trade. But again, yeah, I'm going to watch tomorrow. I'm already really apart from the sterling on a lot of stuff. I'm already in tomorrow really.
Yeah, I think I've lost some of my fibs. I don't know where they've gone. Shut up. That one. No, not that one. I'll have to go and find it. That one. Nope.
The fact is, while you're looking for it, the fact is that it's coming down as rapidly or possibly even more rapidly than when it goes up. So that tells us something about the market. We did have spikes on the way up as well, but it does come down relatively easy. So that is probably something that we may just take into account, the speed of the moves, meaning that we likely are going to find rally sellers on on those yen crosses for a while.
Yeah, and it's looking, this might be significant. We're now holding below 147. Obviously, it's a big level that goes back quite some way. And now we're just, we had moves above it. We've had little tinkles above it, but now we're just starting to hold below. So, get a strong ISM later and we might be back up again. But, that's the way these markets have been. But just you can see now, different lows coming in, just the highs not quite getting as high as before. So, just having a little dribble lower, but holding below 147. I think that's going to be a watch point, particularly when the US come in and we get whatever data today. As I say, get the one of the ISMs, we get some unit labour costs, jobless claims, challenger layoffs, that sort of thing. So we've got some data this afternoon. But I'll just repeat what I've been saying all week. It's where we finish the week that's going to be important for a lot of pairs. Euro dollar's another one. Been saying about this for all year. We're in this downtrend. The downtrend is continuing. We broke to a new low. The highs are coming down. The highs keep getting hit. So this trend is continuing. So it could, at some point, it might find a bottom, but it's not quite ready to do that yet. It tried here, bottom, support. Then we have the break, and now it's looking to hold below. It's creeping. It's not going gangbusters. But you can't ignore this trend. Maybe 107 is the level it needs to find support at, and that's when it puts in a bottom. But for now, but what this one, it does do, it bounces back fairly strongly every time it makes a low. I'm not saying that's going to happen today, but every time we've had a move down, we've had a strong reaction back up, pretty much every time. So, don't rule this one out rallying. Be prepared. If you're short, you're making money, great. Lock yourself in behind. Don't get caught out if it suddenly rallies all the way back up again. But watch this zone. We're below now. It might be that we start finding proper resistance here, and that will give the impetus for another move down. If we go back through it, then we're back in range mode and playing guessing games again. Already looked at cable, euro, sterling. Aussie dollars looking a bit wonky. I got out my long yesterday. I decided to chop it while I had some money on the table in over the fix. But I've added overnight at against this level 40 and 25. And it's not looking too hot at the moment. It's looking like we're getting below this level. So I'm going to be watching this one. I've got my stop below the big figure, but if I don't like the look of it, I might just get out and call it a day, because it now looks like we might start. If I find we're getting resistance here, I'll probably cut it, because it's looking like the zone is broken and the support is now resistance. So that one's not looking too hot. We do have a big level coming up around the big figure. So it's not completely breaking down yet. That 50 fib is going to be important. Through that, boom, we're potentially turning around this trade or this trend. Kiwi needs monitoring. I might be getting tempted. Similar zone to Aussie dollar. Support zone around the 50 fib. This one looks a bit more supportive, maybe because, as mentioned, the RBNZ might be a little bit more hawkish on their last comments, and also from the data. So this might be a little bit stickier if anyone fancies catching a knife. But again, as mentioned, look at the divergence here. It's showing up clearly between the Aussie and the Kiwi. Aussie crapping, Kiwi not as bad. So we're down to coming down to the support line again, which is just a little bit of a wedge going on here. There's a longer term trend line in there which looks a bit washed out. So is this going to hold here as it has been? Is this where it's going to bounce, or is the Aussie crapping out going to keep it going lower? So again, another one to watch for your central bank divergences on this. Dovish wants to look at gold. Let's have a butcher's at gold, and then I'll hand it over to the big man. Oh, look at that. 2030. Every time I look at this, it's trading 2030. Not sure what's changed, Dovish, in this one. We know where support is. It's been tested. It's been confirmed. We know where resistance is. We're not quite getting up to the top end of the range, but we're getting up towards the 50s, 60s. We find it's running into trouble, and then we're coming back to the 30s here. So depending on what you want to do, look at the edges, don't get caught in the middle. That would be my advice on that one. Lastly, S&P still in this one. I added back into this one yesterday after the Fed. I was getting a bit twitchy. I nearly added at 60. I've decided to leave it. I added at 52 instead, and it was looking a bit dodgy because I put a tight stop on it. But after all the Fed washout has happened, we've mooching around, ping-ponging this zone, the same as what we did here. Then we found a bit of support against the old level, and now we're moving back above the zone, above the 60 area. If we hold that move above 60s, maybe we'll undo a bit more of this drop here. I'm not expecting us to rush all the way back to the highs, though. I've already started cutting the bits I put on yesterday, so I'm not going to be slow in taking profits on this one on the way back up, and then I'll see where the levels want to show on the upside. A bit of a minor one going into 70. Okay, I'm passing it on to you, mate.
All right.
Second, bing, 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 all yours.
Oops. Yeah, here we go. One of the things that's weighing on the Aussie right now is Aussie Kiwi. And that's your divergence in between how Aussie data are and Kiwi. It was different for a while there in mid-January because the Aussie had a little better data also than New Zealand. But then on this sticky inflation in New Zealand, it turned around. We are on support here, just below the figure. But I think we need to look at the bigger one here, around 106.70. If that would start to go, then you're probably going to see more weight on Aussie's shoulders. So that's probably going to be one of the keys to trade the Aussie now as well, together with the Aussie dollar, which has broken or in the process of breaking Ryan's support there as well. We've been showing that. We've been trading off that level a few times. 65.25. It feels fragile. Only US data are going to turn this around. Weaker US data, I guess. 65 the figure. If it goes through there, you're probably not looking at a very good picture. There's one, and okay, no, let me first take the Swissy Ali was asking about. Look, on the fixing, and with those community banks stuff, whatever, dollar Swiss spiked lower. I was expecting half expecting this kind of move. So I had my hedges against my 87 call. I had my hedges, and I bought all my hedges back in this zone here. So that's now putting me back, let's say, bias long dollar Swiss. We have resistance here, 86.5. Okay, there is resistance around 86.5 just because of the price action, right? So if that goes through, then I reckon we are going to have a look at the next zone again, and then we are back trading around 87. That is if dollar data outperform. I don't know, Hector. Oh, Horatio, sorry about the Aussie dollar. It's a good question. We'll have to look at what happens at 65, 40, 50, I think, on the other way. So on the dollar Swiss, let's get back to that. If it gets through 86.5, then I'm going to be constructive to get a move back up into the 87s. It's all still Swiss, okay? It has been moving a lot on fixings. Jordan has told us that he's happy. He says that CPI could go back up a little bit, but not expecting it to go back above their 2% upper limit for the inflation. In the meantime, this morning we had the Swiss manufacturing PMI coming in at 43, which is about where it was before, lower than the expectations, but those Swiss data not very often have a very big impact on what's really happening in Swiss. It's really all S&P and the mood, whether the mood is good or not. So yeah, that for the dollar Swiss. And you were asking about the euro Swiss as well. Euro Swiss has trouble to really find its mojo, right? It had that spike during after the end of the year, which was logic. We were saying that's too much. It should correct. We corrected, and then we already found real trouble close to 95 in euro Swiss, and we are back down. We are hovering about 100 points, not even 100 points, 75 points below those spike lows into the year end. We need to see green shoots in Euroland to make this start to go up again, or a very dovish S&P. Yes, this can weigh on the dollar Swiss by any means, but I think we should treat both now a little perhaps different. You will have the dollar side of things, and then you will have the euro side of things. So that's really the picture in the Swiss franc. Euro Swiss has to go back above 60, 65 to start going again. Otherwise, it's looking like a very rangy affair here right now. Yeah, cable, you already looked at it. Oh, we have to look at the Canadian dollar perhaps, because yesterday we had this breakthrough 134, and it was looking really looking a bit like this was starting to go right. But then you had a bit of a turnaround in the oils, coming back from that 79 level down to 76s, and that's now looking as a bit of a failed break, even if the break has been sort of thorough, because we did go 40 points below, but then it's all coming back now, and we're back in the middle of the range, and that had the same effect on the Euro Canada. I was looking for a break here, but then this is starting to look as if it's not really wanting to go too much further right now. So I was short. And I took it all off into the zone again last bit this morning, because it's not. I didn't like the look of the dollar Canada either. If voila, that's really it. I think you've been saved by a bit of a trend line here, Ryan, on your S&P. This one here.
Yeah.
And that comes in around 48.40.
I'll take whatever I can get, mate.
Yeah, I think that's holding. I think we'll have to look at that one for the rest of the day.
Yeah, definitely.
Because below, then you're probably going to get down back to very much closer to 48 and perhaps 47.80 also. But I think this one is one to take into account. It's what I'm looking at. I haven't traded it, but it's what I'm looking at.
Yeah, definitely, mate.
All right, back over to you.
Yeah, thank you, mate. We should call it a day right there. Keep an eye on that data to come. Watch the markets. Watch what the US wants to do with life after the FOMC today. That could be bring some moves around, a little bit more jockeying and stuff. Have a great day, everybody. Watch the BOE. Okay. Have a good one, mate. I will see you tomorrow morning.
Yep. Cheers. Have a good trip. Go Hammers.
Thank you, mate. See you all bright and breezy tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.